On behalf of the Richman Center, a joint venture of Columbia Law School and Columbia Business School, and the Columbia Business School Program for Financial Studies, thank you for joining us tonight. I'm Jesse Green, Senior Fellow at the Richman Center. Tonight's topic on the capital structure of major corporations is important to the missions of both organizations, and of course to the Columbia students from the law school and the business school. For more than a decade, IBM has returned a significant proportion of its earnings to shareholders through dividends and stock buybacks. While activist shareholders have been pursuing companies to step up and return excess cash to shareholders, IBM has consistently been a leader in this regard, doing this year after year after year. To help us understand their perspective and approach, we have Martin Schroeter, Senior Vice President and Chief Financial Officer of IBM, here with us tonight. For a full understanding of capital structure theory and practice, we also have Columbia Business School's Laurie Hodrick, A. Barton, Hepburn Professor of Economics and Founding Director of the Program for Financial Studies and Chair of the program's Advisory Board. Martin Schroeter was named Senior Vice President and Chief Financial Officer, Finance and Enterprise Transformation on January 1st, 2014. He was previously General Manager of IBM Global Financing, a position he held since April of 2011, where he led the world's largest captive IT financer with a total asset base in excess of $37 billion and 125,000 customers in 50 countries. Mr. Schroeter also served as IBM Treasurer, responsible for the company's balance sheet, cash flow, capital structure, interest rate and currency risk management, and treasury operations. Prior to roles in Treasury, he served in a variety of business line and finance executive positions. Mr. Schroeter received his MBA from Carnegie Mellon University and his undergraduate degree from Temple University. Professor Hodrick is known for her groundbreaking research on the corporate financial decisions made by firms, with a particular interest in share repurchases and dividends, takeovers, and equity offerings. She has received numerous awards and research grants, and her work has been published in many acclaimed journals. Major global media outlets such as the Wall Street Journal and the Financial Times seek her commentaries. Prior to joining Columbia Business School faculty in 1996, Professor Hodrick was a professor at the Kellogg Graduate School of Management at Northwestern University. And from 2006 to 2008, she was managing director of Deutsche Bank, where she was global head of alternative investment strategies. She holds a BA in economics from Duke University and a PhD in economics from Stanford. Thanks to both of you for being here tonight. Thank you. I'd just like to add that I was also with IBM for many years, and prior to Martin, I was treasurer of IBM as well, so I understand the background of this discussion tonight very well. To get us started with an understanding of the theory behind capital structure, please welcome Professor Laurie Hodrick.
Thank you very much for inviting me to join this event. Today I want to introduce some theory and some evidence about capital structure and capital allocation. What will emerge is a simple but profoundly important idea. Capital should be utilized at its highest valued use, be that invested by corporations or in other opportunities available to investors. I'll begin with some theory. Capital structure is the choice and amount of securities to issue when raising capital from investors, either to invest, such as capital expenditures or mergers, to hold, or to pay claimants, such as repaying debt, paying dividends, or repurchasing shares. In this definition, I'm emphasizing the sources equals uses constraint, that the after-tax corporate cash flows from operations and the capital raised by issues of debt and or equity plus cash balances are equal to CapEx plus acquisitions plus retiring debt plus dividends plus repurchases. Of course, the seminal theory comes from Modigliani Miller, who consider capital structure in a perfect capital market. That's a market in which all securities are fairly priced. There's no taxes, no transaction costs, no issue costs. There's no asymmetric information between management and the investors. As we know, Modigliani Miller has found that as long as the cash flows generated by the firm's assets are unchanged, a firm's total value does not depend on its capital structure. Their key insight is that when capital structure merely changes the allocation of the assets between debt and equity and does not alter the cash flows themselves, then the value of these cash flows in total must be unchanged. Of course, the value of the relative pieces change, but the total must be unchanged. Further, the firm's weighted average cost of capital is also independent of the capital structure at the return on the assets of the firm. That is the WACC that provides the hurdle rate, which is our opportunity cost, for that amount of asset risk. Therefore, capital structure role in determining firm value must come from changes in the firm's cash flows, which come from market imperfections. In a perfect market assumptions fail to hold, the conservation of value principle I just introduced will also fail. And the choice of capital structure becomes important. It changes firm value. The two largest imperfections, of course, are taxes and financial distress costs. Starting with taxes, the interest tax deduction. Because corporations pay taxes on profits after interest payments are deducted, the interest reduces the corporate tax liability, a saving we refer to as the interest tax shield. If we want to go a step further, include personal tax differential between debt and equity as well, the TC in this graph becomes Merton Miller's T star, the effective tax advantage of debt, but otherwise the graph would look the same. Second, we talk about the present value of the costs of financial distress. To be clear, the issue is not default. The issue is the costs of default. When a firm fails to meet its debt obligations, we say that there exists financial distress or a zone of insolvency. The problem is there's costs associated with that. These include obvious direct costs, lawyers, accountants, court fees, and other expenses. But more importantly, it also includes indirect costs, which have proven in evidence to be much larger. Those indirect costs include distractions to management, the loss of customers, the loss of suppliers, the loss of employees, assets having to be sold in fire sale, the inability to get accounts receivable and such. And it also includes shareholder conflict with bondholders that are induced in default, including risk shifting and underinvestment. So for debt of low debt levels, default risk is low. So the main effect is when we increase leverage is to increase firm value because of the interest tax shield. But as debt increases, the default risk increases. And in the trade-off theory, we're going to get to that marginal point where an additional increase in leverage is exactly offset by the additional present value of the cost of financial distress. And this, by the way, is also where the firm's cost of capital is minimized. Again, creating that WACC, which the firm will use to decide as an opportunity cost, as a hurdle rate for its investments. And again, it's based on, here now, not only asset risk, but financing risk as well. We can then even get a little bit fancier and add other side effects of financing. For example, in the presence of asymmetric information, the effect on managerial incentives. This includes the desire to consume perquisite and empire-building activities. In this sense, the value of the levered firm is equal to the value of the unlevered firm plus the present value of the tax shield minus the present value of the cost of financial distress minus the present value of the agency cost of debt plus the present value of the agency benefits of debt. The optimal debt, again, is based on this trade-off. It's going to balance the costs and the benefits of leverage. And again, it will minimize, it's the point that minimizes the WACC for those asset risk of these assets. For different firms, the relative magnitudes of these costs and benefits will differ based on their firm characteristics. So the optimal leverage will be different across firms. Having discussed capital structure theory, let's next consider the question, why hold cash? Convention dictates that a typical firm should hold only a small fraction of its revenue in cash. It's interesting because few of my students here tonight, I know exactly why. The Paramount case is due tomorrow, and they know this will be available on video. But if you asked them what the amount of cash as a percentage of sales should be, they would evoke the case Clarkson Lumber that they learned in their core corporate finance course. And they would say the answer is 1% of sales. But firms hold cash for many reasons, and that answer is too simplistic. So what do we know? As we learned in the general theory by Keynes, there's a transaction motive. Firms need cash during their ordinary course of business. And what does that say? It says that all else equal, economies of scale imply that larger firms will need a smaller percentage of cash to their sales. There's also a precautionary motive. What does that say? It says that cash can buffer against adverse shocks. And again, what does that mean? It means that all else equal, firms will need more cash when cash flows are riskier. And finally, there is a speculative motive, saying that a firm may be able to profit from future investment opportunities by having some cash on hand. As a consequence, holding cash provides firms with option value, especially in times of heightened uncertainty, because we know that the value of an option is increasing in volatility. As examples of cash as a call option, Warren Buffett considers the benefit of holding cash to be able to buy fire sale assets. Patrick Pichette, Google's CFO, highlights the strategic ability to pounce on a major acquisition were an opportunity to arise. But many, especially in times of heightened uncertainty, focus on cash not as a call, but as a put. John Connor, the former CFO of Microsoft, holds cash to provide insurance in uncertain times. Firms will also hold cash overseas to avoid the material tax consequences associated with repatriating foreign earnings from lower tax jurisdictions, responding legally and rationally to the tax incentive in place. So what do we observe that major corporations do? Typically, 70 to 90% of U.S. long-term corporate funding is done by internal funding. So it's not going to show up on this chart at all. And that's with internally generated cash flows. That is the majority. Next is financed with debt, about half being corporate bonds, which are going to show up here, and about half being private debt, including trade credit, mortgages, and bank loans. When we look at line 2 for the bond issues, we see a record $1.3 trillion. In 2013, for 2014, we're at $1.1 trillion, again on pace for a record year. And U.S. non-financial companies in total have the largest nominal debt of all time. When we move on to line 8, we see the equity numbers. But I remind you, they have not netted out repurchases. These are equity issues. And given the magnitude of repurchases since 1994, there's actually been negative net equity. What does that mean? It means that buybacks are bigger than new issues, and therefore equity is not a use of capital on average. It is actually instead, it is a use of cash as opposed to a source of financing. What connects capital structure and capital allocation is that sources equals uses constraint that I introduced earlier. The key question is how to maximize the use of capital by maximizing the wedge between the return on invested capital and the cost of capital. That may be through investment in the firm, if the company can get the highest positive net present value, or it may be by paying it out to its shareholders and bondholders who can instead invest optimally elsewhere. What we have here is the major uses of cash finance from operations, which include dividends, buybacks, acquisitions, and capital expenditures. And I'm going to pursue them not in the order they are, but in an economic order instead. So I'm actually going to start with capital expenditures because it consumes the largest share of cash flows from operations. And what we see looking at the time series of capital expenditures is it's a pretty steady increase over time. If we then move on to the dividend column, we again see a pretty steady increase over time, which, by the way, is consistent with Lintner's 1956 partial adjustment model idea that corporations smooth dividends. The evidence in the aggregate clearly confirms that, as well as the evidence in the micro. So what I want to focus most on here is the buybacks and acquisitions, because they are following the economic cycle. So notice I included market cap as a column here just to give you one context of thinking about that economic cycle. These change significantly over time, far more responsive than dividends and capex were. Notice, for example, from 2007 to 2008, buybacks reduced 41%. Acquisitions reduced 29%. And then again, if we focus between 2010 and 2011, buybacks increased in 1 year 56%, and acquisitions increased 33%. In responding to the recovery post-Great Recession, we observed a recent surge in buybacks met with a tempered capex expansion. And again, thinking in the context of the sources equals uses constraint, does that reflect, in balance, higher sources of cash flows, or does it reflect exhausted positive net present value, internal capex opportunities? What explains the relative reluctance to build new plants, to launch new products, and to pursue acquisitions? I took this table from a paper called A Century of Capital Structure, The Leveraging of Corporate America, by John Graham, Mark Leary, and Michael Roberts, which is forthcoming in the Journal of Financial Economics, and I think the best unpublished research on capital structure in the United States. Figure 1 examines long-run trends in aggregate leverage ratios through 2010, which is the sample they study. And in particular, what it illustrates is a significant transition in the corporate sector from an equity-based funding model to a debt-based funding model, consistent with what we saw in the Federal Reserve data, which was $1 trillion a year in corporate bond issues and negative net equity. The debt-to-capital ratio was low and stable from 1920 to 1945, but more than tripled from 11% to 35% between 1945 and 1970, before peaking at 47% in 1992. Not in 2010, in 1992. Combined with an increase in non-debt liabilities, the aggregate corporate balance sheet has shifted from less than 25% liabilities in the 30s to over two-thirds liabilities by 1990, before declining to 56% by 2010. Here we see that aggregate cash and short-term investments to assets underwent a significant change that mirrored the change in leverage I just talked about. Cash holdings peaked at nearly 25% of assets in 1945, then steadily declined through 1970 to 6%, roughly the same period in which we saw the leverage increase. Combining the two observations, the leverage increase with the cash increase, we see that net debt to assets has changed even more dramatically, from minus 16% in 1945 to a peak of 21% in 1970. So let's also talk about cash holdings. At $1.649 trillion, there's currently a record level of nominal cash holdings, up from last year's record level of nominal cash holdings. And note that $1 trillion, or 61% of this total, is held overseas. But we also see the cash is very asymmetrically held. The top 5 alone hold 62% of the total. That means the minimum to be in the top 50 is a $5.7 billion cash holding. And when we look at the largest cash holdings, it's specifically held in a subset of highly profitable firms. 20% of this total comes in healthcare and pharma. 55% of it comes in the tech sector. When we look at the top 5 cash holders, they are all in the tech sector, and they alone hold 25% of the total. And Apple alone holds 10% of the total. So what to make of this? I ask the following question in the case that I've written on Microsoft, which is called Cash is King. And again, I'm returning to the idea of cash as a put option. If cash holdings are meant to be a rainy day fund, are these dollars suggesting the firms expect something on the lines of Noah? there is a vocal debate about how much cash these companies should hold and how to best utilize whatever amount is excess cash. Peter Thiel summarizes the challenge well when he observes that's why all these companies are building up hoards of cash, because they don't know what to do with it. But they don't want to admit they're no longer tech companies. But these concerns are nothing new and form the basis, truthfully, of modern agency theory. Benjamin Graham feared excess cash holdings in the 1930s when he warned that treasurers are sleeping soundly these nights while their stockholders walk the floor in worried desperation. But on the other side of the argument, Scott McNeely observes that cash is king. No company ever went out of business for having too much cash. I'm enjoying lending my voice to this discussion, so if you'd like to learn more, you might want to read my paper on the topic. And so when the slides are posted, the link will be available to you. It's my hope that these remarks provide you with both a theoretical and practical foundation with which to consider the remarks we'll enjoy tonight. Again, in my read, the key question specifically is how to best utilize capital, be it investing it internally or paying it out to have others have the opportunity to invest it. Thank you very much.
Mr. Martin Schroeter, the floor is yours.
Terrific. Thank you very much. With your sort of macro view, I'm going to try to put the IBM context now into that and talk about how we think about it. And I'm going to cover, many of the same topics, such as how do we think about our role, what do our investors think about us, and what do our investors expect from us. I'll talk again. I'll put IBM data around it, and then talk a little bit about a set of financials and kind of the path we've traveled, at least more recently, when we think about our own capital structure. So I do have to start with forward-looking statement. Now, interestingly, I learned things every day in my job. I learned this today. So today the market was open, but the SEC was not. So if you needed to file an 8K, the SEC wasn't there to take it. Did you know that? There are 3 days in the year that this happens. I didn't know that. So anyway, we didn't have to file an 8K today, by the way. I'm not saying that. But anyway, today is one day, one of 3 days. Market's open. The SEC was not accepting documentation. So I'm going to start with what I view as our role, I think, with the senior management, and this is not unique to us, this is what senior management does. Senior management is a steward for its shareholders' capital. So while we talk a lot about IBM has this much cash and management can decide what to do with the cash, we recognize, and our shareholders are very clear about this is not our cash. This is their cash. They view it as their cash. When they communicate to us, they say, what are you doing with our cash? They say, you're not going to do that with our money, are you? So they are very clear. They are very clear. They are not confused. This is their money. We are stewards of their money. Now, in IBM, we're over 100 years old. IBM's been around a lot longer. I'm not 100 yet, by the way. IBM's around a lot longer than I've been, and will be here a lot longer than I will be here. So, this is, for me, kind of my time as a steward of a great institution. But again, we should make no mistake. They don't make a mistake. We are stewards. We are stewards of their capital. And as a role as a steward, obviously, you have to think about how you generate the capital, and you have to think about what you do with it. Now, again, I'll put an IBM context into this in a second. This is, I think, it's a good, simple graphic that describes the capital process. So, a pool of investors get together, they put capital into a pool, it gets invested, you earn a profit, hopefully, and then you decide whether or not you reinvest or you return it, right? It's a pretty simple, nobody learned anything from this graphic. Nobody learned anything in this room from this graphic. But it's a pretty simple way to think about what IBM has done now over the last 10 years. So I only picked the last 10. I'm not going to take you back to the days when we did cheese slicers 90 years ago. But over the last 10 years, we have reinvested $133 billion back into IBM in the form of CapEx and acquisitions and research and development. I'm going to talk a little bit more about that in a moment. And we've returned $118 billion through dividends and through share repurchase. So what we would consider to be reasonably balanced, and I think this is what our investors accept as reasonably balanced as well. So when they think about our role as stewards, they are very comfortable with the idea that we reinvest in the business. They expect us to. They expect us to be responsible in the investments. I'll talk a little bit more about how we think about acquisitions. I'll talk a little bit more about what they will let us do, if you want to think about it that way, and what they view as our strengths and the capabilities we bring to the markets we serve. But they also expect us to return capital. Now we are not raising equity capital anymore. We have been since 1915. We've been public. So we had our IPO. Will be a 100-year anniversary of our IPO next year. We're not raising additional equity capital. We've paid a dividend every year since 1916. Touch wood. And we've been returning capital in the form of share repurchase since 1995. And so each year we've been able to reduce our share count, sometimes more, sometimes a little bit less. But each year for almost the past 20 years, we've reduced our share count. So we are in a stage of our firm where when we get to that bifurcation point, we're reinvesting about half. We send about half back to the investors, loosely. So our cash is now having to come from profits we earn. So when we think about the business, when we think about the things in which we're investing, and when we think about the opportunities we're faced with, again, I'm going to talk a little bit about what investors think we're good at, but we're looking for profitable opportunities. We're not looking necessarily just for revenue, what we've in the past called empty calories. So we're not raising additional capital. Everything we reinvest in the business comes back from the profitability we manage to generate, and then we, again, reinvest and also return it to shareholders. So the data is here over the last 10 years. So in total, we've generated $137 billion of free cash flow. $125 billion of that has come from just the net income equation. The other 12 is, roughly over that period, is roughly from a slightly more efficient balance sheet, slightly better operational performance, but it's basically net income drives it, a little bit of efficiency out of the balance sheet. And you can see then on the right-hand side of the chart how we've used that. So obviously on a free cash flow base, when you think about the cash flow statement, operating cash flow is first, then you pull out net capital. That's the $41 billion we have here, and that gets the free cash flow. That's the $137. And then we've reinvested some of that in acquisitions, $27 billion net. We're also divest companies. I'll come back to that in a moment. And then we've paid $26 billion in dividends, and we've returned $92 billion in the form of share repurchase. So again, reasonably balanced in that overall free cash flow equation. I'm going to come back to the capital structure and the debt side of this over the last 10 years in a moment. But again, we've been public almost 100 years. Everything we reinvest or return is coming out of the profitability we can generate. We are very much focused on profitability as opposed to revenue growth. And you can see that in the data behind me now. So over the last 10 years, that red line, I think it's reddish line that goes through, that's profit. $6 billion of profit 10 years ago. We've essentially tripled it over the last 10 years to $18 billion. I'm going to talk a little bit about how we do that. Again, it feeds into what investors think we're good at and what investors will allow us, if you will, to do with their money. But at the same time of tripling profit, we've only increased our revenue by 1% on a compound basis. So we are not a big revenue grower. Now that includes, or excludes, depending on how you want to say it, that reflects the effect of divestitures on our business as well. We grew the rest of the business a few points more than that, but it's not like we're a 10 or 12% growing firm. We're not. We're $100 billion in revenue. Next year will be a bit less because we're in the process of divesting part of our low-end server business, but we are not a big revenue grower. We really are just focused on that profit cycle, which is, again, the source of our reinvestment and the source of our returns to our shareholders. Oh, I think I went the wrong way. There we go. Now, we operate in enterprise IT. So we don't have consumer products. We don't do phones. And in enterprise IT, where we have a pretty strong capability, our investors have a view about what we're good at. And they have a view, by the way, of what the industry looks like as well. Now, we share our view. This reflects our view. So anybody, I would argue, who owns our stock, thinks this is the future of enterprise IT. So our view of enterprise IT says as the world is shifting, it's going through a few transformations. One is data is becoming a new natural resource. Now, data's been around a long time. Been around a long time? Data's been around a long time. The idea of using data to make business decisions, if it didn't exist when I was in graduate school 23 years ago, I would have been a lot better off. But the fact is, we've been using data a long time. But in the world of big data with a new natural resource, now we have both structured and unstructured data. We have data coming out of all the websites and Facebook and Twitter. In fact, we just announced a partnership with Twitter. I'll come back to that in a moment. But there's a lot more data being created in both a structured and unstructured way that's helping our clients, our enterprise clients, learn more about their customers. And so that's driving a change in how industries work. It's driving a change in professions. It's certainly changing the CFO profession. It's changed my prior role as a treasurer. It's different. There's a lot more data to use. There are a lot more tools to use to work on that data. But data is fundamentally transforming the way enterprises work and the way professions operate. We see that. We have a big data business. Not big data. We have a data business that is large. I'll say it that way for clarity. And we still see this as another big opportunity. We also see the next step in big data as being what we call cognitive. And the way to think about cognitive data is in the past, and you currently do it as well, when you're looking for relationships between some data, you program a computer and you go attack the data. And when you need more, thanks to Moore's law, you can throw more processing power at it. That's not the way it works in these big data sets where you're not exactly sure what you're looking for. In cognitive data, your data sits in a corpus, not a great name, I recognize, but I didn't name it, in a corpus of data, and your data learns essentially about itself, and then you interact with your data and try to find the relationship. So it's a different way of thinking about how to deal with these big data sets. That's what our system that we call Watson does. Watson isn't something you can program. Watson is something that ingests your data, learns about it, and then you interact with it. That's big data. We also see a big shift coming in the world of enterprise IT around the shift to a cloud. So you could ask 10 people what a cloud is, you'll get 11 different answers. The fact is that a cloud it's somewhat new in the sense that it's a new way to deliver IT. But what it really does, in addition to having some positive economics in certain applications, what it really does is it provides enterprises with a level of agility that they couldn't get before. So instead of having to buy all this gear and put all this software on it, getting up and running, you can move something onto the cloud, which gets you up and running much faster. Think about it that way. Think about it as a tool for agility. It's having a profound effect on the way our clients are thinking about their data and their operations. It's obviously having a big impact on us, and it's not going away. There will be continued workload shifted into the cloud. We have a point of view. Our investors trust, if you will, our point of view and agree with our point of view, but they allow us to operate and invest in that space because they see our point of view relative to what they see in enterprise IT. Finally, there are what we call new systems of engagement, mobile and social networks that are allowing our clients to interact with their customers. In the enterprise world that we operate in, security is vital. So if you have a phone in which you do your banking, I do some banking on my phone, but you can imagine how important that the bank treats that data and its ability to keep bad things out of its systems. So in the world of mobile and social, all of which are generating lots of data that our clients use to learn about their customers, there's also a big component of security. Again, our investors view the world similarly to the way we view it, which is this will drive a pretty substantial change in the way companies operate. We can take advantage of that because we can help clients move into a more mobile and social world, and we can do it profitably. So that's a long way of saying our view of the world gets represented to our shareholders. They have an opinion about what our capabilities are and our ability to be successful. And their view of enterprise IT lines up with our view, and therefore they trust us to invest their money. I went the wrong way again. There we go. They trust us to use their money to invest in these. So they also have a view of how relevant we are in these spaces. You don't have to read all the statistics. I can just net it all out for you. We're big. We're big. So we still have about 70% of the world's business data sitting in and around IBM systems. many of you probably weren't alive when the first article was written, but for a long time we've been reading the article that the mainframe is dead. Since the first article was written that the mainframe is dead, the mainframe capacity in the world has expanded by 40x, not by 40%, by 40x, because the mainframe remains the most robust, most reliable, most secure system by which to process business data. So all this is saying is that our investors have a view of where enterprise IT is going, and have a view of what position we hold within enterprise IT. Right? Because your investors, again, you have to take them along here when they're starting to when you're starting to spend their money. We've also noted up here that as the world shifts, as companies move in and out and decide how they're going to invest, there are new opportunities. So in our case, we formed an alliance recently with Apple, where our ability to work with an enterprise helps their ability at getting their apps and their design capabilities into an enterprise environment. Building an app on an iPhone is one thing. Building an app on an iPhone that a bank or a train or a plane will let you into their systems of record, that's a whole different ballgame. So we teamed up with Apple. We're working on the first 12 apps will be out this quarter. But it's I think it's a recognition of two aspects of this. One, Apple's investors think they're really good at design and making things simple and easy to use, and these will be the most elegant apps you can imagine. And they also believe that IBM has that infrastructure, that enterprise capability to deliver it. We did recently sign an agreement with Twitter, whereby we will ingest Twitter data. I think it's measured in tweets, but I couldn't tell you how many. We will ingest Twitter data, we'll put it into Watson, and Watson will now allow Twitter's customers to interrogate the data and see what it can learn. And recently we signed a deal with SAP, where SAP will run its application on the IBM cloud. So they will not pursue a cloud strategy of their own, if you will. They'll obviously make their applications capable of running on the cloud, but from an investment perspective, they chose us to make the investment on their behalf as opposed to them. I don't know what their discussion was with their investors or their investor groups, but they made the decision that rather than have them put the capital in, they think we'd be better at it for them, so they came to us. So again, investors have a view of the world and where it's moving. They also have a view of your capabilities, and then they have a view of how attractive this is. What this chart shows is where the profit pools are, not just the revenue pools. So the bars show revenue, and you can see the data from 1980 to 2013. Percent opportunity means revenue. So back in 1980, whatever that is, 34 years ago, only 5% of the revenue was available within the software side of IT, enterprise IT. Only 4% of the profit. This is very profitable, but only 5 and 4. And you can see hardware was 80% of the revenue pool and 81% of the profit pool. Fast forward to 2013, and now we have only 14% of the revenue in software, but a third of the profit pool sits in software within, again, enterprise IT, and it's come all from the hardware side of the business. So when I start talking about divestitures and the things we've done and the acquisitions and the way we've invested our investors' capital, you can see why we have a slightly different view than just all revenue is good revenue. All revenue is not good revenue. There is a lot of empty calories out in the world in our space, and investors, again, have a view of where they think the profit opportunities are and what you're doing with their money. So for IBM, we've continued to mix away from the commoditizing businesses. I'll put up a list in a moment of what that meant for us. But we moved away from the commoditizing businesses, and we continue to move toward where the margin opportunity is. So you can see in just the last 10 years, we were split 30, 33, and 36, hardware, software, and services. And now our hardware business just last year was down to 7% of our profit, and services was nearly half, and software was nearly the other half. Now, the business we just sold in our STG business had no profit in it, so I don't expect that to change this much. It'll just change the revenue mix a bit. But our mix now, you can see, mirrors or more aggressive than the opportunity that we see, in the marketplace. So when we think about our margin expansion, when we think about the importance of margin expansion instead of revenue, we've been pretty disciplined about growing margins every year, 10 years in a row. It's come out of a combination of mixing to software. It's come out of a combination of improving our hardware and our services businesses. And it's come out of kind of a base productivity where we continue to find ways to operate the IBM platform in what we call a globally integrated enterprise, so that when we move into a country or we expand in China or we move into Africa as we're doing now, we don't have to take our investors' money and rebuild IBM to support all of Africa. So we don't have to put payroll in, we don't have to put procurement in, we don't have to put accounting in. We run on a common platform so that our investors' money is best used to expand the sales and the delivery resource that those regions need. And that's driven, again, some pretty good productivity numbers for us. So as the investors have a view of the world and what's appealing, what they think you're good at, they also have a view of what you're good at and what your capabilities are, which drives them to allow you, or in some cases to not allow you, to pursue your strategy. They also have a view of who you're up against. This is not to say that this is a list of everyone we bid against from a financial perspective or a strategic perspective. The point of the chart is that the numbers get really big. There is a lot of money out there chasing some of these opportunities. And we recognize that because of our success, people, enterprises, are out there chasing the same space as we are. So, we spend pretty aggressively. I showed you earlier that over the last 10 years, we spent about $133 billion in terms of reinvestment, $13 billion a year. Even a CFO can do that math in his head over 10 years. But $13 billion is a pretty big number. But you got to spend pretty aggressively if you're going to keep up with those that you might be up against. Pools of capital have grown enormously. They have grown enormously, and you got to compete with it. And so we see pretty big numbers, but again, we have to continue to bet pretty aggressively and pretty heavily in the places that our investors think we have capability and a high probability of earning profits, not just revenue. So as we transform our business, we become both buyers and sellers, and we've bought more than we've sold, but here's the data. So we've divested, most famously probably our PC business back in 2005 to Lenovo, but we've also divested a printer business just this year. There are more than this, by the way, but just this year we divested a customer care business, our x86, our Intel Common Platform, industry standard platform business, and just a couple of weeks ago we announced the divestiture of our microelectronics semiconductor manufacturing, which included our microelectronics OEM business. In total, those three were $7 billion of revenue, $7 billion of annual revenue, and in total, we lost $500 million in that, in all three of those, not each, $500 million in total. So very much a disciplined approach. Revenue is not important, it's profitability that's important. That's what our investors always tell us. I was at the RBC conference today, and in the RBC conferences, you tend to do, you get a big room where Q&A with the analysts from the bank, and then you do a series of smaller rooms with maybe 5 or 6 investors in each. And I did three of the smaller rooms today, so about 20. Out of the 20 people who were in the room over the course of the day, 5 of them said, "You're not looking at a big acquisition just to get revenue, are you?" So it is top of mind for them. It is absolutely top of mind that our strategy has not changed, even though they continue to read about a lot of ideas we get about who we should buy. You should go buy this, it's big. We get 10 bankers a month in telling me what we should buy. They tend to be big, but bankers get paid on the size of the deal. So we get a lot of input on what we should buy, but our investors are not confused. They want us to continue to divest of things that don't make money, and they want us to buy, that's the acquisition side of the chart, they want us to buy the capabilities we need. Now, there is a nuance to what they want us to buy. They don't want us to buy something because we think it can fundamentally change IBM. That's not what they're looking to do. They want us to buy where we can get, we obviously pay a premium, but we can recoup our premium fairly quickly because it hasn't either scaled rapidly or it hasn't scaled enough or as quickly as it needs to. So our acquisitions, one, have a set of economics that are going to provide a return to our investors. We don't do things that, with the infamous air quotes, we don't do things that are strategic, which is a euphemism for I'm never going to make this a good idea, but I'm just going to call it strategic. That's not the way we think about our acquisition portfolio. So every acquisition has a set of economics that will demonstrate it's a good investment. It also has to complement what we think we're good at. So it has to fit into our view of the future. I showed you earlier data, cloud, and engagement. That's our view of enterprise IT. So an acquisition has to complement what we're doing within that. And then they generally tend to be intellectual property based, because that's something that we can get into our distribution channel overnight. So that means taking something that maybe is in 5 countries or 6 countries or even 10 countries and expanding it into 162 countries overnight. That allows us to earn back our premium pretty quickly, and we do pay a pretty big premium. As you can see by the profitability of the software business, everyone sees, by the way, that same data. They might have a slightly different view of it, but it's not too far off our view. Software businesses are very sticky. Software businesses are high margin. And software businesses are quite valuable. So we're bidding against big pools of capital to build the stickiest software business that has some legs. And again, we have a view of what the world of enterprise IT is. Most of the people who operate in this industry don't have a dramatically different view. They might have some different capabilities, but not a dramatically different view from what we see. So we've been pretty acquisitive. We've bought over 120 companies since 2004. We spent about $34 billion of our shareholders' money. And they ask us about it. I'll come back to this in a minute, but they ask us about how it's going. They do view, as I mentioned, they do view this as their money. The largest we've made is this company in the middle there, Cognos, a Canadian company. They have a kind of a front end within the data analytics space. That largest acquisition was just over $5 billion. That was the largest acquisition we've done. Now, acquisitions are part of it, but we also spend pretty heavily in CapEx, and we spend pretty heavily in R&D. So when you look over the last 10 years, this is the annual view of that $133 billion I showed you on an earlier slide 2 or 3. But if you look at those two bottom bars, and you see where they cut off, it's pretty flat. We spend about $10 billion every year on CapEx and on R&D. Now we've shifted the business, so we're obviously not spending on the same things. What we used to spend, for instance, on developing a bit of technology around, say, an X series industry standard server, now we'll move into a cloud. Now we'll move into developing more cloud capabilities. So within that constant spend of 10, we do reallocate and we do shift our spending to go after new opportunities. But it is pretty important when you're in a business like ours, which is based on intellectual property. Many of our businesses are based on being first. And because once you're first, nobody can catch you anymore. But we have to spend a pretty set amount. We spend about a pretty set amount, about $10 billion. Even through the most recent recession, we spent like 9 and change. So pretty level, but that's what's required to be competitive, again, against these big pools of capital. And then we supplement that, as I showed you earlier, with our acquisition spending, which was $34 billion over the last 10 years. So pretty aggressive spending, but again, there are big pools of capital out there that are chasing very similar spaces. And then finally, our investors demand, rightfully so, demand to know what we're doing with their money. So we like to think, we get reasonable feedback, we like to think we're pretty transparent. We show them what the portfolio looks like, we show them where the growth characteristics are, we show them the mix of our portfolio in terms of hardware and software and services and the margins we get. We show them how we allocate their capital and what we're going to spend, likely to spend on acquisitions, and how much we're going to return to them. And then because we're so acquisitive, we've been very open about the performance of our acquisitions. And we show, you don't have to read the data on the chart, but we show them every year how our acquisitions are performing. It's their money, they have a right to know. So we're very, very open about how their money is doing. We believe that it helps us. We have a fairly complex company to begin with, so the more we can explain, the better off we are from an investor perspective. And then finally, we have, our shareholders still have a vote. Every share has a vote. We don't have any other share structure that's different from that, so they maintain, if you will, their control over the stewards with their voting. So we're very transparent about how we're spending their money, and we continue to give them, they continue to have, I should say, a vote in how we do this. So just a few more comments. I only have like another 50 charts and then we'll be done. Well, I tried. It's only 48. Just a couple of comments on our capital structure. So 3 columns, total IBM, global financing, and core. I'll come back to that in a second. As Jesse indicated, I was a GM of our global financing business. We are the largest IT financier. It's solely IT. We're not doing anything but information technology. So we're the largest financier of IT. We're also the largest trader of used equipment in the world, of used IT equipment, not used equipment, used IT equipment. So that business is really there to do 2 things. It writes leases and provides loans to our end user clients. So we can help them procure, acquire, whatever you want to think about in terms of IT solutions, not just IBM, others as well. And then we're providing capital to our business partners, which is much shorter term in nature, high turnover, but we have business partners who need to buy hardware, integrate it, and get it out to their clients. That has to be supported with a stream of capital. We provide that capital for them. So this is, at this point, it was about $40 billion in assets. That's with some cash. It has about $28 billion worth of debt and about $4 billion of equity. So we run this business at a leverage of 7 to 1. It's a financing business, and we couldn't be competitive in the marketplace without having a leveraged financial position. But 7 to 1 is enough for us to be competitive. That represents a very unique strip of the IBM balance sheet because it's not reflective of the rest of the IBM balance sheet, which we have now in the core. The repayment for the debt in the global financing business will come as those assets unwind. Now, it's our goal to continue to grow that, so hopefully that they don't unwind the assets. But if we unwound that asset base, 7 out of every $8 would go back to the bondholders. Only a small strip of equity left for us. In the core business now, which is the rest of what people think about that IBM does, sales of hardware and software and services business, we have debt in that capital structure as well. About 12, this is a forward-looking statement now, about 12 at the end of the year, which is about, I'll show you in a second, about where we were at the end of last year. And an equity base of about 19 billion, book equity. Now, we obviously have debt in the capital structure this year. We had it in last year. This is a history now of the core debt. So if you were to look at the annual reports from IBM, you wouldn't find this data by itself. You'd see a total debt number. But again, we have a financing business that is generating most of the debt. This is now the history of our core debt position. And from a core debt position, we reintroduced debt into the capital structure in 2007. In 2007, we finished with about 12 billion of debt at the end of the year. We will finish this year with about 12 to 13 billion, roughly, on an estimated basis. So over that, since we've reintroduced debt, over that time, that time period, we've added $1 billion or 2 of debt. Now, at that same time, you can see the data, nearly 30 billion of CapEx, 23 billion of acquisitions, and then 24 billion of dividends and 88 billion of share repurchase. So this goes back now to that circle I showed you in the beginning, the super simple circle, if you will. Our business model, our financial model, driven by reinvestment and driven by return of capital to shareholders, is all embedded within the profitability of the enterprise. We're not out raising new capital, we're returning capital. We've been fortunate that we have a set of capabilities that allow us to operate in a highly profitable way. On a pre-tax basis, we'll have 20 billion of pre-tax income this year. Roughly 20 billion of pre-tax income, generates a lot of cash, and again, that's our source of both reinvestment and of return to shareholders. So our capital structure now, reasonably stable over the long period. I don't expect we'll find ourselves in a position where we would take core debt back out of the capital structure. It's the right way for us to run, but I also don't see an opportunity for us, given where we are currently in the future, that we would dramatically add to it, because I don't see an opportunity other than to buy more of our own stock back. I don't see necessarily an opportunity to expand that either. So we're at a pretty stable capital position right now, given the near-term future. So, excuse me, with that as a background, I think, Jesse, the question and answer time will begin.
Yes.
Thank you very much for your attention, and I think you're going to join us up here as well.
Yes.
Fabulous.
Thank you, Martin. Just a follow-on comment. to the amount of cash on balance sheets. This goes back many years to when I was treasurer, and I was at a Treasury conference in California, and I asked one of the big techs who at that time had well over $100 billion in the balance sheet. I said, "Why do you have so much cash?" And we were doing the same thing you're doing at IBM. And they said, "Well, the people, the management, the line management wants enough cash so they can replace the entire franchise if they were to be attacked." So the defensive thinking that was going on was quite substantial, right? So quite different from the way IBM thinks about this, of course, right?
Yeah, but having said that, we do behave defensively at times as well. So in 2009, as the world was going into this sort of unbelievable liquidity state, and big banks were, you had to worry if the system was going to stay up, right? We saw, watching the Bloomberg on that day, I know you were there, you watched the Bloomberg, and when Treasury bills start to trade negative, it's not only an interesting phenomena, but it means that people are avoiding the banking system, right? And the banking system is a flow system, so if the inflows stop, if companies like IBM stop putting their money in, that means they can't pay out on the other side. It's a very equilibrated flow system. So as you watch this and you see treasuries trade negative, we did go out in 2009 and do our largest debt offering in October of 2009, as you remember, but it was a defensive position because you couldn't tell what was going to happen. You have to protect the franchise, right? Optimal capital structure is one thing, surviving until January is another. Right. And so we do behave defensively when we see risks to the franchise. And 2009, it was hard to tell what was going to happen day to day.
Right. You paid up for that. We paid up for that.
We did pay extra for it, but we also slept well.
Right. Absolutely.
Well, we slept reasonably well.
In the piece I wrote about Microsoft's 2004 cash payout, the CFO is quoted as saying they want a minimum of a year as if they had no revenue at all.
Yeah.
To allow for that insurance.
Yep.
Does that mean I have to keep $100 billion?
Offshore?
Stan, did you get that number?
Martin, before we go to the audience, and Laurie, before we go to the audience, I have one question I would like to get out here. One of the questions, IBM's definitely done a great job of returns to shareholders. No question about that. You've grown your overall profit margins as well. So look at the picture. Overall, the long-term story is great. Recently, you've had some operating difficulties. Clearly, the last quarter was a difficult one. So the question comes up, you spend a lot of money on CapEx, you spend a lot of money on a lot of things. Is it enough? How do you know, how does any corporation know, not just IBM, but any corporation know that they're spending enough and consistently spending enough given the long-term uncertainty we face?
Yeah, it's a good question. In many ways, and in the short term, it's a bit of a false choice of, do you do this or this? The fact is, for us, we get to do both, and obviously we're moving back and forth between how much of each, but we still get to do both. We get to reinvest, and we get to return capital to shareholders. There are a few things we can look at. We do have a view of the opportunity profile that we see, particularly the profit opportunity. So. I do think, could we go out and buy more revenue? Absolutely. But revenue is not necessarily going to help us, as we spend some time talking about in terms of what our model is. So you have to find the profit opportunities. When we think about how much capability we buy through our investments, so as an example, when we think about the move to the cloud and our own software platform, we announced this year something called Bluemix. Bluemix is for the more technically inclined, our platform as a service. Think about it as a way that someone might hook something from their cloud back into their systems of record. Now, that requires an investment, and we put up to $1 billion into platform as a service to get Bluemix going. Is $1 billion to move onto a platform as a service enough? Absolutely. Now, as you know, everything in IBM has a B on the end, right? So it wouldn't make a press release, you wouldn't talk about it, it didn't have a B on the end. But is $1 billion enough to build a platform as a service? It is absolutely enough. One of the things we look at is how are we doing? Again, we're in an intellectual property-based business. How are we doing from a capture of intellectual property? 20 years, now 21 years in a row, we remain the patent leader in America. We develop more patents than anybody else. Those patents are in spaces that we think will provide long-term value, both on a platform basis like things like Watson or Bluemix, as well as patents in lots of our other software portfolio, whether it's on-prem or transaction product, doesn't matter. So there are a few ways. Again, we're in a lucky position where we get to do both. There are a few ways where we have to make sure that the amounts we're spending are sufficient, but to do the kinds of things we're doing, the kinds of things our investors trust us to do, and we look at how many resources we have applied to those relative to what we see in the marketplace, when we look at the map of intellectual property and who's creating it and who has it and who has what we want, we can get pretty comfortable that we're spending the right amount. For us, it's always been about how do you shift what you're doing to the new spaces? How do you stop doing things that are no longer providing a return, and how do you put more into where you see the returns?
One more question before I go to the audience. I'm going to go to the audience in just a minute. How influenced is the moves of competitors on your long-term strategic investment rates? If you're looking at your capital spending, your R&D, you didn't mention the fact, I think you have about a 6% R&D spend, or percent of revenue
Yes,
at IBM.
roughly.
So that can be added to the numbers up there, which are included in the profit.
Yeah, some of them are in there.
Yeah, some of them there, right.
I mean, competitor moves in our industry are very, very important. But we tend to have a longer-term view of our business. So, and we tend to act, as you know, in a long-term way. So I guess one way to think about it, as I mentioned earlier, just a few weeks ago, we announced the divestiture of our semiconductor manufacturing operations. So we were a subscale semiconductor manufacturing. The last thing you want to be is a subscale semiconductor manufacturer because the capital requirements are so substantial. Now, we believe very strongly in the power of our platform, our mainframe, and our power platform, and its long-term viability, even with others sort of circling the data center and others having a view of what they might like to go after in the data center. So they're going to make their moves, but we felt our strongest play is the continued support and the continued technological development of those high-end platforms. However, we have a subscale manufacturing problem now, and it's not a problem in 2 years, it's not even a problem in 3 years. But in 4, 5, 6, 7 years down the road, when all of a sudden your wafer size has to double, and now you've got to put another 8 or 10 billion of capital to build a plant, now all of a sudden you've got a big problem. So we're already subscale. We knew we had this problem for a couple of years. We've been working on it for a couple of years. But these are long, long cycles, right? We're not talking about, this is a 10-year deal we signed. We're not talking about getting to 14 nanometer. We're talking about 10 and 7 and even what goes beyond silicon. So you have to have a long-term view in this business. What your competitors are doing is absolutely important, but you have to position yourself knowing what's important to clients, which is both a combination of innovation and productivity. Are there other things that are important to clients? Yes, but if you had to generalize, you have to deliver innovation and you have to deliver productivity. And so, as an example, getting off of that subscale platform allows us now to keep those platforms going for the long term. It was a terrific move for us. And we have now a supplier that has scale. GlobalFoundries absolutely has scale.
I'd like to go to the audience now for questions. Any questions from the audience? Over here.
It's nice to see.
Can you speak up, please?
Yes, sir. It's nice to see your focus on profitability, return on invested capital, and optimal capital allocation. But this isn't the case at all public companies or all companies at all. I was curious what led IBM to focus on these items, and also your view from the seat as a public company CFO, why other companies don't focus on these very important items.
Well, we do it. It's the right thing to do. It's not like we feel like we're making a choice here. Again, as I started in the beginning, we very much view ourselves as stewards of not only a great enterprise, but we're stewards of our shareholders' capital. So I don't think we're making a choice. I think we're doing our jobs, quite frankly. Why others view it differently? They may have a different investor base. They may have a base of investors who are asking them to behave differently. They may have investor base that's looking at different aspects of the business. They may have an investor base that has a different view of what will drive their enterprise value. From an IBM perspective, which I know, which I deal with, our investors are again pretty clear about what they expect from us. And it wasn't, again, I don't think we made a choice. I think we're just, this is our job, stewards of their capital. Now, we do have the beneficiary, I think, in IBM. We do have a terrific culture that's built around this. It's not like It's not like we have to build that culture. We have a culture that's very much built around how we interact with our clients, and we have a culture that's very much built around how we interact with our shareholders and what our shareholders expect from us. So, the simple answer is this is what we do. This is our job. I don't think we've made the choice.
Yes.
Do you see share buybacks as an opportunity to opportunistically take advantage of inefficiencies in the way that your stock is priced? And if so, do you see that now is a good time to increase the amount of capital that you return?
Yeah, it's an interesting question, and we do have this debate on pretty regularly. We think about whether or not there is an economic way to purchase, and should we try more economically. I mean, what we have done traditionally is we've just been steadily returning capital. Now, our cash flows are skewed. They don't all happen evenly throughout the quarter. So we're thinking about the needs of the business, and we're thinking about where that cash happens to be at any particular time. And we're trying to balance a series of not difficult, but a whole lot of simple equations, if you will. But having said that, we don't tend to have a stated economic goal of saying, every time the stock gets below a certain X, we're going to buy at a different rate, and every time it goes above a certain X, we're going to buy at a lower rate. And the reason we haven't done that is because it's very difficult to communicate with your investors then what exactly they can expect. They expect a fairly robust set of communications so they can understand what they expect to get back from you. And if you go into a year, or if you're talking to 2 or 3 or 4 years down the road, if you tell them, every time the attribute is this, I'm going to go buy some, they don't know what to do with it. And they prefer, their communication has been, we prefer just a regular flow in because that helps us understand then where you're going to be. But there is certainly an argument to be made that there is an economic approach to do this, but you just have to figure out if you have the right investor base that would prefer it, or if your investor base prefers the certainty of knowing they're going to get a certain amount back over a certain period of time. But it is a pretty, like I said, pretty regularly debated within IBM as well, if there's a different way. On a micro level, we have blackout periods like all public companies do. So when we go into blackout, we go into a trading plan. Trading plan is we write down very specifically what the agent should do on our behalf, and that lasts usually a month or so. And within that trading plan, we will give them a little bit of economic framework. Now, over a month, the stock price trading is fairly nominal. The range isn't that wide, and the fact is that we give them minimums they have to get out as well. So on a micro way, we do think about it a little bit, just so that we can manage the agents, if you will. But at a macro level, our investors really want to know with some certainty what they can expect to get out of us.
Can I follow up that question?
Of course.
In the past 20 years, you've gone from 2.3 billion shares outstanding to less than 1 billion.
Yes.
How low will you take it?
Well, if I had the last one, I'd be okay. It's hard to say. I think
no assets
not
left.
if there are no assets left. Yeah, no, I think it's hard to imagine where the end point is, right? So one, I'd say a few things. One, within that framework, we've had the benefit of, over that long period of time, we have the benefit of slightly different cash dynamics than we have today, including, I know you had an example where there were no taxes in the world. I'd like to live in that world. But we do have taxes, and so cash rates and book rates are changing, and as you know, our access to cash is constrained by where our reinvestment priorities are. Our access to cash is impacted by the tax code at any one time. We're big advocates of fundamental tax reform, not one-time things, but just fundamental tax reform. So we have a view that we can continue, even in a different relationship, if you will, between cash and income going forward. We have a view that we can continue to reduce our share count by 2 or 3 points a year. Now, it'll take us a long time to get through then 1 billion shares, but that's kind of what we think we can do on a pretty steady state basis, given the profitability of the firm. That'll take us a long time. It'll be long after I'm gone.
Martin, I remember when I was back there, some investors felt that the stock was really going to take off when the shares continued to reduce.
Right with them.
Yeah. That's still their view?
Well, I think those who hold us obviously see an opportunity, right?
Yeah.
Now, we also have a fairly stable share registry. When we look at our top holders over the last 15 years, there has not been a lot of change. We've had one big investor come in, this guy named Warren Buffett. You guys may have heard of him. He came in a few years ago. He owns now a bit over 7% of IBM. Maybe he'll buy the other 93, and I won't have to worry about then the last 2 or 3% a year. But he owns the biggest chunk. Other than that, we've had a pretty stable share registry. And it's sort of an enviable position as the CFO because you get to visit with investors who say, just so you know, we now have a negative cost basis in your shares because we've given them so many dividends over the years that they actually have a negative cost basis, which is a terrific feeling. So we have a pretty stable share registry. I would expect that it's a combination of all the things I talked about, right? They understand our spaces. They understand how we invest. They understand how disciplined we are about their use of their money. And they understand our capability and our capacity to execute what the strategy is. So they feel reasonably comfortable. I don't think many of them go to sleep at night assuming that we're 10 days or 20 days away from like another 40 points in the stock. I don't think they think about it that way. But the combination of a steady dividend, which has been growing, double-digit increases the last 20 years, steady dividend, which has been growing, a steady reduction in the share count, and a disciplined approach to management, I do think they feel reasonably comfortable that this thing will keep going.
Yeah. Right here.
So in practice, how do you come up with the optimal capital structure? So when you see the slide, in 12 billion in 2007 and 4 billion in global financial crisis, and goes back to 12 billion. So in CFO office, how does that really work?
I come to a school at Columbia and hire all their students. Well, we do exactly what you think we would do. You know, we do run, for instance, we don't do it every day, obviously, but we do calculate. We know what our weighted average cost of capital is. We have a view of what the cash flows of the business look like. We have a view of our costs of debt. They're observable. So all those parameters you work with in class, all the parameters that the professor had in her charts, we have a view of that. Some we estimate, some we can get out of the marketplace, but we have a view of all that, and we use theory to then determine what would an optimal capital structure be. Now, to that, we apply what I would call the reality of our environment at the time. If we have a big pension challenge coming, we have a big pension, right? Doesn't show up on the balance sheet, but we have a pension asset that's north of $120 billion. A pension liability that's about the same, by the way. We're not in an underfunded position. We're overfunded, touch wood, but we got a big pension liability we got to deal with. So we take the theory, we can estimate the theory, and then we apply to that the realities of what we know we have coming. But we do exactly what the professor showed when we think about the cost of our balance sheet, if you will. We also operationalize it by making sure that there are within the management system both rewards or penalties when you absorb too much of our capital. So you get a business plan, just like you get a budget for revenue, you get a budget for profit. You also get a budget of how much capital you're allowed to use, and if you go over that, we charge you for the capital. It's a way to incentivize at a unit level the things you want them to work on. So the theory gets built. We apply then the realities that we know we have to deal with, and then we find ways to operationalize that through both a reward or a penalty system that makes sure that the 400,000 people who call themselves IBMers are all working on the same stuff that we think they're working on for the benefit of both our clients as well as our shareholders. There is a way to do it all, but it all starts with the theory.
Yes.
So do your homework.
We'll leave that here.
So I find it really interesting how your R&D spend is very constant throughout the years. I was wondering if you could talk about the rationale behind keeping that constant and spending money on acquisitions versus using the acquisition money and using that to develop technologies in-house.
Yeah, in many of our businesses, there is a speed to market advantage. And you cannot acquire the skills you need, you cannot acquire the talent, and you can't get to where companies have gotten to as quickly as you can if you just pay the premium and buy them. So in the case of security technology, for instance, we have some terrific security technologists. We spend money on people who've got propellers on their heads. They're mathematicians who can do just amazing things, but our entire math force, we have the largest private math department in the world, they are all fully employed. So if we find another opportunity in security, as an example, we're pulling them off something else and putting them on this. And rather than have to make that trade-off, sometimes it's easier to go out and acquire technologies that we see that, again, very smart people have gotten to a level that makes sense for us and we can integrate. So we're fortunate that we get to do both. We get to both continue to build very good in-house capabilities through research and development. And while the spend is flat, as you saw, relatively flat, the things we're spending on are turning over quite a bit. 10 years ago, it would have been a fair bit on material science and semiconductor technologies and things and services. And we've shifted that now to still have some services, but a lot on software, a lot on getting our platform into more of a software as a service world. So there's a lot of churn underneath that. But the short answer to your question is sometimes it's much better for a speed to market advantage when you have everyone fully deployed working on things that are valuable to the firm to pay the premium, go out and buy it, and you get where you need to be much, much faster.
Okay. Another question? Yes, over here.
Why is it good for shareholders to have the financing and the core business together rather than, let's say, spin off the financing business?
Yeah, it's an interesting question. So from an operational perspective, there's a lot of synergies when the teams go out together because from our client's perspective, the technology decision is immediately followed by or immediately preceded by the holy cow, how are we going to pay for it decision. And so having our teams there together provides a solution, if you will, that our clients can now address both the technology side as well as how they're going to pay for it. We get a lot of integration advantages from doing that. They're both good businesses, by the way. We should start with the premise that the financing business is about a 40% ROE business, and the base business on a book basis is even better, much higher ROEs, because we continue to buy back shares, so we continue to deplete that capital account. So they're both good businesses. The financing business benefits from that sales activity. It also benefits very heavily from knowing not only what future of technology is going to be worth, it's our labs that are building our hardware, it's our lab and that's developing what that processor technology curve, so we get a lot of insight in our financing business from that. But they also get a lot of insight into customer behavior, as do our operating teams, our core business teams, a lot of insight into customer behavior, so that when you have a financed asset and you are 33 months or 30 months or even 24 months into a 36-month lease, our operating teams now know, and they can share information, now know that they can go out to a client and say, you're in the right part of your lease right now. We can give you twice as much technology. You don't have to pay any different. Are you interested? So it becomes a pretty compelling value proposition for our teams, given the information they have, and it's a pretty compelling value proposition for our financing teams to make sure they stay linked in front of a client. And again, that sharing of information drives opportunities for both of them. If they were separate, we would not have that opportunity to share. It's a pretty powerful model when it's together.
Other questions over here?
How would you recommend your investors to examine the team or the firm's capability, capital allocation capability, especially in making acquisitions or investments?
Well, I think most of them start with everything we produce publicly. So we have a lot of people spending a lot of time writing this annual report. I'm hoping you're reading it, by the way. If you tell me you're reading it, you'll make a lot of people really happy. So we are a reasonably complex company, as I said, and part of what I think, therefore, we have to do is be very clear about how we're doing on our acquisition portfolio. We pulled out only one sample of a slide that we show, but we actually show 10 times that to our investors in terms of giving them an ability to analyze our success in acquisitions. We tell them how much we expect those acquisitions to drive in terms of profitability. So we give them a lot of data, not only the annual report data and the Qs, we give them a lot of data in Investor Day and other things to have them to help them, if you will, understand the financial aspects of this. Technologically, maybe you wouldn't be surprised, but a lot of them like to go out and see what it is they bought, or what it is we bought, or what it is we're investing in. So, we just opened further south from here a new Watson building. And in the Watson building, which is, again, our cognitive system, we have a whole series of examples of how Watson's being deployed in healthcare, in financial services, solving our clients' problems. A lot of our investors, it's not just clients who go there, a lot of our investors want to go in there and, to use the old phrase, kick the tires. They want to understand both the technological side. They have a lot of opinions about others' technological capabilities as well. So they want to understand technologically what they think our capabilities are. And they do the same thing with their acquisitions. So we bought a company last year called SoftLayer. SoftLayer is our enterprise-grade cloud. It's in Texas. It's in other places as well, but it's headquartered in Texas. We had a lot of our investors go through to understand what SoftLayer can really do. We host a lot of interactive investor feedback with the teams that run these businesses, so that they can explain the technological aspects of what all of these things do. So I think we're pretty open. I think they expect us to be pretty open. They certainly form an opinion about our capabilities, and they form an opinion about the financials as well. And I think that's sort of our job, is to make sure they can understand a pretty complex story, and we do it with all these different forums. So I think it works pretty well. I think it works pretty well. They know a fair bit about us.
Other questions? Over here, yes?
On the same note, as you continue your partnerships with Apple and Epic, especially in the healthcare space with Allocate, how do you expect that to drive future profits?
Well, Apple is an interesting case. So, as I mentioned, Apple, the first dozen apps on Apple will come out in the fourth quarter. I've seen some of them, and the one thing that, this won't surprise anybody, but Apple, they are just genius at simplifying and at design. So the things that we had done that would take 4 screens, they can do in a half. It's just amazing how that whole culture is built around design and simplicity. Now, they bring that, and we bring the knowledge of the enterprise. We bring the infrastructure that allows Apple and IBM to show up in a client's office and say, not just wow them with the screen, but wow them with let me show you how the provisioning works. Let me show you how the security works. Let me show you how the network capabilities work. So there is clearly here a bringing together of two companies that know their own spaces but could not do it without one or the other. None of that is yet in our financials. Obviously, we have a pretty big pipeline. We think it's a pretty substantial pipeline. But until we start to get some points on the board here, until we start to get some implementations, we're going to have to let this thing ramp. Spending a lot of time. It has worked quite well. Touch wood from what we've seen so far. But we got pretty high hopes for this. Twitter is similar, not as I'd say, not the same obviously as Apple. Twitter though has a unique spot in the world. And the amount of data they're capturing and the value of that data, in order to get it, you really do need a cognitive system to help you understand. As I mentioned earlier, it's one thing to program a computer to go find a relationship, but you don't even know what you're looking for, right? So the ability of a cognitive computer like Watson to ingest all of this data and then go interact with it is pretty powerful. There's nobody else they could have done that with, just like there was nobody else Apple could have found to introduce them to the enterprise. There's nobody else that Twitter could have found to help them get the most value out of their data. I don't know what that's going to be worth yet. We'll have to see. I'm not sure they know what it's going to be worth yet, by the way, because we don't know what we found, right? We don't even know what we're looking for yet. And then things like SAP. SAP is the SAP choosing the IBM cloud. It's just a reflection of what we've been saying, which is enterprise-grade clouds are different from public clouds, and you have to understand the difference. And SAP is obviously an enterprise company as well, so they understand the reliability and the security aspects of what it takes to run an enterprise. I think that's just a reflection again of our knowledge of the enterprise. These will be pretty big businesses. They will have an impact. There's nothing in there yet for them, but they will have an impact on IBM overall, and an impact that allows us in a differentiated way to continue to drive margin. So pretty good opportunities for us.
Okay, we have a few minutes left. Jeff?
So the press has carried stories about how your firm has shifted from an EPS growth strategy with a target to one that's different from that. which a firm makes that kind of pivot, about how that occurs and the dynamics within the firm and the kind of management decision-making that goes about that.
Well, I mean, I think we got to first step back, and the way the press characterizes things may not be the way we think about them, or the way they should be characterized. So we've had we'll get a little bit of a history lesson. In 2007, part of the feedback we were getting from our investors that you're very complex, you're very hard to understand. Help us understand how IBM works. Help us understand what IBM can deliver. And so we developed this roadmap concept back in 2007, and we first one went from 2007 to 2010. And then obviously we're still a complex company, so we still have to explain ourselves. We used a similar framework to go to 2015. But the intent of the roadmap approach has been to take what is our strategy, to show our investors how we allocate capital against that strategy, and then to translate all of that into a term that our investors can use for shorthand, which is you take that strategy, our set of capabilities, and this allocation of capital, and we think we could achieve this level of EPS at a point in time. That was the communication of the roadmap. So what we've changed is not the strategy, and we certainly haven't changed necessarily how we're going to allocate capital. We're going to both reinvest in the business and continue to return capital to shareholders. What's changed coming out of the third quarter is that when we look at the trajectory we're on, just like we had always looked at the trajectory every quarter prior to that and said, nope, we still have a path to get to 2015. When we came out of the third quarter, for macro reasons, for a series of transformational reasons, we said, we just don't see that path to that end point anymore. And that's really what's changed. So, currency alone has a big impact on this. Now, we're only 15 months away from that end point, and currency, the stronger dollar we saw in September, dropped us pretty substantially just by itself. Now, we have operational challenges we have to get through in the business as well. I'm not saying that currency was the sole thing, but currency alone, given you're only 15 months away, is something we have to start thinking about. So the allocation of capital, the strategy has not changed. It really is just that the trajectory we see coming out of September was not one that allowed us to say we can still make that same $20 in 2015. But it really is the strategy and the allocation of capital that remains sort of the centerpiece of the IBM financial model. Moving to higher value hasn't changed. We're still divesting of businesses where we don't see value. We'll still acquire where we think we can produce positive economics. Enterprise focused hasn't changed. It really only is that endpoint that we see is not in the trajectory anymore.
What I meant was the internal piece. So for example, speaking about CapEx, that might have been your job. So is it then your responsibility to sort of present to a senior board, this is going to have the impact on the business? I mean, how does that occur internally to make that what is perceived to be that major shift? So what's the internal process like about that? Whose light bulb goes off? And how does that get?
How do you communicate that through? How does the currency impact?
Well, I mean, currency as an example, we take our board through our financials every board meeting. We explain to them the financial dynamics of the entire business, including currency. They understand where what has happened historically, and they understand what that impact is going forward. So we communicate that through the board, through senior management. The same. Maybe I'm missing your question, but it's not there's nothing. I guess there's nothing different about this process than it ever has been. We still run a financial forecast process. We still run an actuals review process, if you will, and that runs through the board, through senior management, all the units.
But the forecasting process picks up the currency trends
Absolutely.
that are occurring and projects out where those are headed over
Absolutely.
time.
Forecasting process. We do in finance. We do the math of if rates stay here. We don't predict what rates could be in future, but if rates stay here, this is the impact on the business. Absolutely. We do that every month.
Right.
We do it more frequently if we think we need to.
So the impact is very clear to everybody.
Absolutely.
People see it.
Absolutely.
And know if it hangs around too long at that level, you know what the dynamics are going to be as it rolls through the results.
Absolutely.
We're about out of time. I want to thank Professor Laurie Hodrick and Martin Schroeter, CFO of IBM, for their time tonight. This has been very enlightening. I appreciate all of you being here tonight. I'd like to thank Kathleen and Camille of the Richman Center for their support in putting this program together. I'd like to